Good afternoon, everyone. Good morning or good evening, depending on where you're joining us from across Canada. Thank you for spending your lunch hour with us today. I am Jigar Kanjani with Supply Chain Canada West, and I'll be your host for what promises to be a really valuable session. Today's webinar is Economic Outlook 2026, the forces shaping supply chains. If you are involved in procurement, planning, budgeting, or really any form of strategic decision making, you are in exactly the right place. A few quick housekeeping items before we get started. Firstly, this session is being recorded. The recording, along with the slide deck, will be emailed to all the registered participants after the webinar. So don't worry about capturing every detail here. This session qualifies for two CPD points for SCMP members in Alberta. These will be added automatically. For members in other provinces, you'll need to log them manually. Please note that more than 50% attendance is required to qualify. And we will be tracking your attendance through the Zoom platform here. You are in listen only mode for the presentation. For questions, please use the Q&A button at the bottom of the Zoom window. Start sending those questions right away at any time during the presentation. We will have a dedicated Q&A segment at the end of the session. Now, moderating today's session and guiding our conversation is someone many of you know well, Alan Toe, SCMP, President and CEO of Supply Chain Canada West. Alan brings over a decade of leadership experience from Suncor and TransAlta and is a graduate of Harvard Business School's Executive Leadership Program. He'll be setting the stage for today's topic and introducing our speaker. Alan, over to you.
Hey, thanks, Jigar. I want to thank all of you for joining us for today's webinar on Canada's economic outlook. At a time when we're all navigating trade uncertainty, geopolitical issues, as we sort of see in the news this morning, inflationary pressure, fiscal policy shifts, labor market constraints, and all these evolving global demand patterns, understanding the broader economic landscape is really, really essential. And for supply chain professionals like ourselves, economic conditions influence everything that we do. Interest rates affect capital investment and inventory decisions. We know that exchange rates shape sourcing strategies. Fiscal policies influence infrastructure spending and public procurement and trade flows, productivity trends, which I'm really happy that Trevor's going to get in today, and regional growth patterns directly impact logistics network, supplier stability, and long-term planning as well. So to lead and contribute effectively to the organizations that we support, we must understand the macroeconomic forces shaping our operating environment. And with that, I am so pleased to have joining us today Dr. Trevor Tombe, professor of economic at the University of Calgary and one of Canada's leading public finance and macroeconomic policy experts. Trevor's research focuses on fiscal policy, internal trade, productivity, and economic growth, and he's a widely respected voice in national policy discussion and frequently contributes analysis on Canada's economic outlook and competitiveness. In fact, Trevor was kind enough to join us recently with our council and with our members here in Calgary as we talk to Canada's productivity issues with a broader group around trade labor availability, and that constraint in Canada. So that was an excellent contribution, and I want to thank Trevor for that contribution as well. Today, Trevor will be helping us unpack what lies ahead for Canada, including the key risks, opportunities, and structural trends that supply chain leaders should be watching. As Jigar mentioned, I encourage you all to make this into an interactive session. Please use the Q&A function in Zoom throughout the presentations to submit your questions. We'll make sure to leave time at the end to address as many questions as possible. And just recognize that your questions will help shape a much richer discussion for everyone as well. So just put your questions into the Q&A functionality, both Jigger and I will be keeping an eye on that, and we'll group that together and we'll direct those questions to Trevor at the end. So, with that, it is my pleasure to now pass the presentation over to Trevor for his presentation. Trevor.
Great. Thank you, Alan. And thanks to everyone for taking the time today. I think there's, as Alan noted, no shortage of important economic developments that have been occurring pretty frequently over the past 12, 13 months now. And I think it's hard enough to kind of stay up on what those changes are, let alone what the implications of them are, both for Canada's economy today and into the future. So today I want to unpack, I guess, in the next 40, 45 minutes or so, some of what I think of as the most important developments involving some trade policy changes, inflation pressures, and recent changes there, as well as the real-time state of Canada's economy and labor markets, before concluding with kind of a longer-term perspective on productivity in Canada, where it is right now and where it's going. Now, maybe I'll begin with a slight caveat here that, of course, the world is moving very fast at the moment on a lot of fronts. And so, much of what I might say today is conditional on the state of the world as it was last week when I put this talk together and a little bit over the weekend. Energy prices have increased dramatically following the conflicts now escalating in the Middle East, a little under $70 per barrel. That's going to have impacts kind of throughout the economy. It'll have some beneficial impacts for Alberta in terms of public finances. I'll talk about that in a sec. But broadly speaking, depending on how long this is sustained or if energy prices increase further from here, we may find ourselves in a situation where inflation pressures begin to mount again. Just for context, a $10 per barrel change in the price of oil typically is associated with about a 0.4 percentage point increase in the overall pace of Canadian inflation. So, of course, depending on how long that is sustained and how central banks here and around the world see that kind of shock, it may have implications for interest rates as well. There's also been some fiscal policy changes in Alberta that might be of interest. I won't talk too much about the budget in detail other than to make a couple of points. The deficit the province is looking at this year is among the larger ones in its history, at roughly equivalent to about 2% of GDP. That kind of makes Alberta's balance overall roughly comparable to what we see in the federal government at the moment. And much of that is due to spending increases. I'll give some context on that, but it is raising questions among credit rating agencies as well. This morning, in fact, DBRS didn't downgrade the province, but kind of signaled that ongoing deficits and rising debt in the province may, and I quote, exhaust flexibility within the current credit rating, which is an interesting way of saying, depending on how long this lasts in Alberta, there may be a downgrade to come. Now, what we're looking at here are Alberta total spending levels per person adjusted for inflation. A lot of what we're hearing from the government is comments around population growth pressures being the cause of the higher spending, but that wouldn't cause a change in spending per capita. But what we're seeing with Budget 2026, highlighted in green, as you can see, is a level of per person spending in Alberta that is now set to exceed the highest level under former Premier Notley, and behind only the 2013 spike associated with the flood in Calgary. And so we are approaching, on a per person basis, adjusted for inflation, the highest level of spending ever. And the contrast between Smith and Kinney is, I think, quite notable. And this is not something that was forced on the province. It's something that their own policy choices kind of led to. So my last point on this before turning to the broader Canadian economy is that the government might have made a mistake in 2023. I don't actually know if they made a mistake, but in retrospect, they set a ceiling on spending that would evolve only with population and inflation. And therefore, in a lot of their communications, do point to that as their main fiscal anchor. And that provides a ceiling of spending of 70.5 billion this year, which they're coming in, as you can see in the first bar, a little bit below that in terms of overall operating spending there. But the ceiling that they set that would evolve over time had two problems with it. It included some temporary COVID spending that if you strip out and just look at core operations of government, the ceiling is quite a bit below, about $3.5 billion, sorry, $2.5 billion below what it actually is this year. And the way they incorporated the population and inflation adjustments with a little bit of a lag, for interesting reasons we don't need to get into, also led to an artificially high ceiling this year. So an anchor tied to population and inflation would have led to about 65 billion in spending this year, not over 70. So about 5.5 billion of the 9.4 billion deficit is due to spending choices exceeding population plus inflation. So that's important context, I think, to understand Alberta's fiscal position. It's really due to spending choices that we made. But with oil prices rising this morning quite considerably, that deficit might easily shrink, depending on how long they stay elevated for, something on the order of 2 to 2.5 billion. We need, for context, $75 per barrel to balance. Anyway, enough about Alberta, certainly relevant to any Albertans here joining us today, but let's take a step back and think about the broader Canadian economy and recent developments in Canada-US trade. Now, if we dial the clock back to January, we had average tariffs in the United States that were something on the order of, depending on how you measure it, 19%. On average on imports into the United States. Some countries higher, some countries lower. But then, of course, about 2 weeks ago, we had a Supreme Court ruling that invalidated any tariff under the International Economic Emergencies Act. I'm forgetting an acronym, the IEPA legislation. And that led to a sharp drop in tariffs for a couple of days. So February 20th, the average was quite a bit lower than what it was previously, coming in at an average of 6%. So dramatic change in trade policy. But things snapped back. And last week, implementing tariffs in the United States under a different piece of legislation have increased that to now just under 10%. So, big changes, and that creates uncertainty, of course, for businesses to navigate, and many of the professionals on this call to navigate as well. The level of tariffs is far, far below what the president originally announced back in April. And so a lot of the trade disruptions are far better than I think anyone could have reasonably anticipated, even just a few months ago. That's not true everywhere in the world. So the latest international data here is from December. There's not something more recent than that. Shows that Canada is actually coming in with tariff levels quite a bit below what we see elsewhere. And so depending on the nature of the supply chains the businesses here in Canada are connecting with, maybe there are imported parts from different countries elsewhere, or operations here in the United States, kind of thinking about where they're purchasing from. All the variation in tariffs here matters quite a bit. But overall, Canada's in a good place on average. This doesn't tell the full picture, though. And one way of quantifying how much drag there is on Canada-US trade as a result of tariff policies maybe not best captured by this measure of average tariff rates, which are, depending on how you measure it, between 3 to 4%, far below what we see elsewhere. Some items have very high tariffs on them. Think about steel and aluminum, or pretty significant tariffs within manufacturing sector or softwood lumber or others. So there is a measure that is calculated monthly. And I'd recommend actually the website Trade War Tracker, put out by a really top trade economist in the United States, Michael Waugh, that quantifies what would the tariff be if it was uniform across all products, but result in the same total trade volume with the United States as actual tariff rates do. So high rates on some products, zero rates on others. What would be the uniform tariff that would have the equivalent trade volume associated with it? This is a much better way of thinking about how restrictive US trade policy is. And here you get a very different picture with much higher rates than what we were looking at previously. Canada's facing an overall trade restrictiveness index, it's called, of about 12%. Again, this is not an average tariff, but this is what the US tariff would be in an alternative universe where the tariff applied uniformly on everything and result in the same amount of trade between Canada and the United States as exists right now. And so the level of restrictiveness is much higher, even in Canada. And the gap between us and the rest of the world is smaller than you'd conclude based on just average tariffs alone. It'll be interesting to watch this when the data for February comes in, not yet available, but what happened with the Supreme Court ruling and the replacement tariff. It'll have an impact on this for sure. Now, in terms of trade, put tariffs aside, Canadian trade volumes, really had experienced quite a lot of increases and decreases. So across all countries, we exported a lot in the lead up to and anticipation of disruptions, and then a lot less. We're kind of back to our normal trend level, both in terms of exports and imports overall for Canadian trade. But when you look at the United States, we're trading now about 10% less overall than we were prior to all of the trade policy changes beginning. Our exports to them are about 5 billion less, as are our imports from them. So trade volumes between us and the United States are quite a bit below where they were. This is going to have implications for Canada's overall rate of economic growth, and we have slowed down in that growth. Labor markets have weakened, although it looks like they've turned the corner, as I'll talk about in a bit, precisely because we gain from trade, and when there is less trade, we gain less. And the trade policy changes have really dampened those trade volumes by quite a considerable amount. Indeed, our retaliation to those tariffs have also lowered trade volumes. And so one way to see that is to look at how Canadian imports from the United States have evolved in recent months on items that we levied retaliatory tariffs on, relative to all other items where we didn't levy a retaliatory tariff on. So the dark line here, the dark teal line, is the items with retaliation, and the orange line are the items without. They're, of course, noisy month to month in terms of how they're changing, but roughly speaking, items that we levied a retaliatory tariff on, like the Canadian government levied tariffs on, are down about 20% compared to not just past values, but items where we didn't retaliate. Notice, though, that the effect has extended past the life of the retaliation itself. There are some items that we still have retaliation on, but we abandoned most of the retaliation in September or September 1st of last year. But notice for several months now, even after the retaliation on most items was lifted, trade volumes on those items are still about 20% lower. Now, I don't want to, offer a concrete explanation for this, but potentially consumer behavioral changes have persisted. There are, of course, the boycotts that some consumers have chosen to go with, just not purchasing where they can products from the United States. But the retaliation also raised prices, which could have changed purchasing behavior, shifting them to other markets or other substitutes. And that shift in behavior appears to last even after the price effect of the tariff disappears. Whether this is permanent or not, how long this lasts, I don't know. Too soon to tell, but it is quite interesting that trade volumes on items that we retaliated on are remaining low, even after the tariff is lifted. I think the broader lesson here is that even if US trade policy snaps back to normal instantly tomorrow, and of course it won't, but if it did, there might be lasting economic effects and lasting effects on trade volumes for years to come. Let me just jump quickly here to two measures where there might be scope for a little bit of optimism. Uncertainty has improved relative to where it was last year, spiking at roughly triple the rate that we saw in the worst moment of the pandemic. It's come down now, it's about half as high. But, and this is a big but, it's still much higher than we normally experience. And uncertainty means lower investment and lower hiring. And the number of jobs that are, or sorry, the number of job vacancies and hiring that we're seeing in sectors where the US is an important market is far, far below the pace of hiring that we see in all other sectors of the Canadian economy. And so I don't have the exact number off the top of my head, but it's about 3% lower overall employment and hiring in sectors exposed to the United States, whereas there's growth in sectors not exposed to the United States. And a lot of that is uncertainty beyond just tariffs. One bright spot, though, is some business sentiment has started to improve. This is very important for investment and hiring decisions as we look ahead in Canada's economy. In February, the CFIB, in its regular survey of small and medium-sized enterprises in Canada, has that the overall sentiment, as measured by the share of businesses expecting stronger performance in the coming year, has reached highs not observed since the immediate recovery of COVID. And notice we're at levels in February here that are comparable to the years prior to a decade ago, 2015. You have to go back to find comparable levels of positive business sentiment at this level. So that's encouraging. Despite the high uncertainty, it may very well be that the fact that the economy has not gone into recession, that U.S. policy has not been, at the really high levels that the president was communicating last year, that it does seem like we're settling into something that's workable, and businesses are seeing that in their sentiment. And as we'll see in a bit, we're seeing that in terms of a dramatic improvement in recent labor market conditions in Canada. But let me turn to inflation now. This is an area where I think there's some real risks, depending on developments in the Middle East and depending on world energy prices. Much of the inflation rise that we saw in 2022 and 2023, though not all, but much of it was connected to energy price spikes, with global oil prices exceeding $120 a barrel at peak following Russia's invasion of Ukraine. So when you have energy prices changing very dramatically, that can have really big implications for inflation, because first, energy is a direct component of the overall price of average goods that we buy, because we buy energy directly, whether gasoline or utilities for home heating and so on. It also just cascades through supply chains because energy is an important input into almost everything. And food is among the most energy intensive non-energy products, though there's several months of lag between when these kind of input cost shocks affect consumers. The risk really is there. And there might be some conflicting signals around whether inflation over the past couple of months or the next several will rise or fall. And I'll show you some of the data here. So first, all the way up through until the most recent data point that is available shows that inflation, all items or excluding food and energy or the various Bank of Canada core measures, they've all been kind of flat over the last little while. That's good, but flat at a level that's slightly higher than 2% and materially higher than the typical level that existed for several years before COVID. Okay, so inflation has not returned entirely to normal just yet. Now, there's lots of different ways of measuring inflation, and some components here are quite volatile. And so you don't want to be, as a policymaker and as a central bank, overreacting to volatile components. And so what the bank does is looks at several core measures. And I'm not going to talk about the details of these unless there's questions to come, but we try and strip out through various techniques the volatile components to get a sense of what the core inflation pressure is. And it turns out these core measures are typically much better predictors of inflation to come, even with the headline all-in CPI index. And here we're kind of well within the bank's target range. And over the past couple of months, even 2 out of the 3 measures have seen decreases to rates below any point since the early months of the pandemic. And so this suggests that inflation pressures are falling. They were mounting there for a little bit of time, as you can see, late 2024, early 2025, but that's reversed. Another way to think about it is to decompose underlying components of the CPI and ask what's driving the headline rate of inflation that we're seeing. So here, accommodation, whether owned or rented, energy, vehicles and furniture, which are subject to international kind of supply chain bottlenecks, as we saw back in late 2021 and 2022, those have all kind of contributed far less to overall inflation than they typically do. Energy actually being a decrease in inflation as energy prices have been lower recently than what they had been previously. But look at the green line here in this graph. Look at food. It's now on the rise and has been for several months in terms of the amount that it's contributing to overall headline inflation. So there is inflation pressure, and it's in food specifically. Okay, most other areas of the CPI are fine. It's food that's really driving a lot of that increase. Now, I want to unpack that a little bit because food price increases, you might think groceries. And naturally, that would be a great initial thought to have. But there are other ways in which we consume food, restaurants being a big one. And so let's think about where we are. The most recent data point is January. What does that compare to say, last spring, which is, if you kind of squint at this graph, the low point of the headline CPI most recently? The increase since May, the biggest drivers of that is restaurants and groceries. But notice restaurants roughly triple the contribution to the increase in inflation than groceries. And so, yeah, food prices are rising, but the increase is being driven by restaurants rather than groceries. That's important because it affects how you think about the underlying cause of the price pressure. Is it cost pressures facing farmers? Is it machinery fuel? I mentioned gasoline. This is an important impact there for agricultural costs. Is it fertilizers? These are things where the last inflation spike we went through were driven in large part because of shocks to fertilizer and energy. It turns out that, well, with restaurants, it's really not all that. It's this graph here. It's that services in general are seeing an increase in inflation. And in fact, services in general are seeing an inflation rate that's really rivaling the peak that we saw during the last inflation spike. Now, unfortunately, Statistics Canada doesn't actually produce this series anymore, asking what's the average price change for services, excluding shelter, excluding housing. But you can reconstruct it. And so that's what the blue line is here. My reconstruction of what StatsCan stopped reporting some time ago. And you can see it clearly rising in 2025. And so that's kind of the big issue affecting restaurants and other services as well. Could this be maybe wage pressures? We've seen wage growth exceeding inflation for a while now as purchasing power of individuals has recovered following the inflation spike. But wage increases that exceed productivity growth, means that business costs rise, and so too must prices. Now, I don't know, but that's one potential factor here, and I'll talk about productivity in a second. I guess, now I'll skip this, given the time. Won't go through supply and demand. Let's turn to the state of Canada's economy overall, and then conclude with some thoughts on productivity and where we may be headed. And so the current state, by that I mean literally the right now, what's the first quarter of 2026 looking like in Canada's economy? What's the second quarter? Like, where are we projected to head this year? Of course, with the caveat that uncertainty is very high and global developments may, knock any projection off the rails. But if we think about quarterly growth and we dial the clock back a couple of weeks before we got the fourth quarter of 2025 data, the projections were pretty strong. These are my own projections that are produced. Don't need to get into the details of how they're produced, but they're very similar to what the Canadian Chamber of Commerce does in its regular and statistically driven projection of quarterly GDP growth. As if you go to their website, the Canadian Chamber of Commerce has what they call a BDL Now tool, and every week it's updated in terms of the projections that they put forward. It's a really great tool. But anyway, my own was that the fourth quarter of 2025 would come in at 2.3%. It came in negative, so a little bit of a miss there. Notice the projections, though, are still fairly strong in the coming quarters for this year, averaging about 2% growth this year. Now, you might look at this and going like, well, he projected 2.3% for the fourth quarter of last year, and it actually came in negative. What kind of useless projection is this? I do want to flag, though, that the negative growth that did get a lot of headlines at the tail end of 2025 shouldn't be seen as weakness in the Canadian economy. And that might seem a little strange. But if you unpack the components of growth that quarter, you see that the negative is driven by inventories. A lot of what some businesses did through 2025 was build up inventories, perhaps in anticipation of policies changing, perhaps shipping things across borders in advance of anticipated tariff changes. Individual circumstances will vary, but as things normalize, they're going to be then depleting the unusual increase in inventories that they were building up before. And inventories is the most volatile component of GDP. It rises and falls by quite a bit. Notice other components of GDP growth, from exports to capital to machinery and equipment to final consumption spending, both by households and even by governments through fiscal policy, were all positive and all kind of meaningfully positive as well. And so this fourth quarter negative shouldn't be seen, just to repeat myself, as weakness. It just kind of the consequence of depleting inventories, but that's not an effect that has any persistence. So the projections out through this year, continuing on with growth of about 2%. And that's in line with what many others anticipate as well. The overall strengthening of the economy, you can also see it kind of directly in the labor market. The unemployment rate has been falling quite a bit in recent months, right across the country. And so we have now in Canada, among working age individuals, an unemployment rate of 6.6%, basically the same in Alberta as well. And so the improving labor market is kind of a consequence of improving business sentiment and increased hiring, for example, and that's quite welcome. Some way to go for sure. Like, this is not at the moment what we should see as a normal rate of unemployment, but it's now been pointing in the right direction for several months as the economy strengthens. That's quite welcome because the labor market so far has been not just weak, but historically weak outside of recessions. In fact, the employment rate At its worst point, which was several months ago now, at its worst point was 2% below its peak level, which is, as you can see here, a rate of employment reduction that is in excess of most post-World War II recessions. It's come up a little bit. Now it's only 1.5% below. So it's got about 3/4 of the decline left to recover from. Um, that's quite welcome. We rarely in Canadian history see this kind of weak labor market outside of recessions. And a lot of this is due to most recently uncertainty and reduced hiring. There's one area of weakness, though, that continues, and that I think an area of weakness that raises a lot of questions for the health of Canada's economy going forward, and that's business investment. If we look back over many, many quarters now, it's not just that it has experienced weak growth, it's that it has shrunk consistently, time and time again. Fourth quarter of last year, if you squint, you can see it, a small negative. But that's then the fourth quarter of negative business investment growth in a row. In fact, you look back over the last 4 full years, and only 4 quarters of them were positive. So 3 out of 4 quarters, we have seen reductions in business investment. This matters because business investment is a critical driver of many things, but perhaps the most important for the long-term health of Canada's economy is business investment drives labor productivity. How much do individuals produce typically per hour? What's the value of our labor? How much is our income? And what's the purchasing power of that income? All of that is connected largely, like overwhelmingly, to labor productivity. And labor productivity is driven overwhelmingly by business investment. Having more machinery, equipment, technology available allows us to produce more value per hour and therefore sustainably have higher incomes and greater purchasing power. And productivity growth in Canada has been really quite low. And so I think it's worth reflecting on where we've been over the last couple of years and then think about where we might go from here, what some of the policy options are, how to think about the long-term ability of the Canadian economy to recover from this era of slow productivity growth. And the takeaway message here on this slide is, I think, one that I want to have lodged into everyone's mind, is that fixing this challenge is going to take decades. So independent of what's going on in the United States, we have a lot of heavy lifting ahead on this front. And you can see the problem in a few different ways. Before I even show measures of productivity, if there's time, I'll just show that you can just immediately see some of the weakness of Canada's economy. First, following COVID, we haven't returned to the growth trajectory that we were on. We, of course, contracted during COVID quite a bit and recovered mostly from that by within 2 years. But we've been persistently below our previous trend. It's as though we're producing below our own potential as measured from what our trend growth was previously. Now we're about 4% below that trend. And 4% is quite significant. Every 1% here is worth about $30 billion. And so 4% is foregone production and foregone value and foregone income of about $120 billion. So a pretty significant gap in where our economy is and where it might have been had COVID not occurred. Another comparison that you may have seen, because it's been something that many have pointed to, is our performance relative to the United States in terms of how much we produce per person. This is a common measure of productivity. And I'll say that while some note immigration changes as a potential driver of some of the decrease in GDP per capita, the issue predates immigration changes and still exists right now, even though the pace of population growth has returned not just to normal, but is far lower and negative currently. And the problem still persists all the way through to the fourth quarter of 2025. long after the immigration policy change in recent years has been reversed. Notice for 20 years between the mid 90s and 2015, we kind of rose and fell with the US. Not perfectly, but almost perfectly over that span of time. Had we kept pace as we normally were keeping pace in the past, Canada's GDP today, I reckon, would be about 18.5% larger than it is in the fourth quarter of 2025. That's a $600 billion per year gap in economic activity. So that's the productivity challenge that is getting a lot of attention today. We've been increasing at the pace of about 0.2% per year. Whereas for 20 straight years previously, we were growing at an average pace per year that was about 1.5%. So far, far larger. And the gap between us and the United States is wider now than at any point since the Second World War. And I'll return to this graph in a bit to think about where we might be headed from here, but we're now at about 70% of the US level. Whereas normally, it goes up and down with commodity prices, as you can see, we'd be closer to 80% of the US level. And that gap is significant and meaningful. Now, it's not uniformly shared across the country. Alberta and Saskatchewan are much higher than the Canadian average, but for the most part, Canadian provinces are far lower than US states in terms of their average level of GDP per capita. 2024 data is unfortunately the most recent that is available, according to this measure. But notice the three maritime provinces are the bottom of all provinces and states in terms of overall levels of economic strength. Ontario, now a little above Alabama. So recent headlines, we've improved slightly in that metric, but only slightly. So Ontario is behind South Carolina, ahead just barely of Idaho, and barely ahead of Alabama, Kentucky, Oklahoma, right? So many parts of Canada are punching below their potential, I think. And this is because of productivity growth having lagged for so long. It's not just the US experiencing strong growth. Now, the US is experiencing faster than average growth, but if you look over all OECD economies, we've increased overall since the first quarter of 2015. And this is in total over this entire decade plus, far, far lower than the average of all OECD economies. And so it's a unique challenge in Canada. Mexico, too, is experiencing this slowdown over this span of time as well. Much of it is, of course, related to trade uncertainty, as that shouldn't come as any surprise. But it's a problem with significant implications for living standards in Canada. So what might be done? Well, there's lots of potential changes that governments are exploring now, some with a little bit more vigor than others, but internal trade. Very relevant, perhaps, for anyone here joining us today at a firm with operations across the country or seeking to buy and sell from different parts of the country. Sometimes that can be complicated because of different regulatory burdens that exist in one province or another, having to for agricultural goods, sometimes go through multiple inspections. Sometimes there are requirements for certain types of products or safety equipment to be sourced at particular sites, and those requirements are different in different provinces. And so there are costs of internal trade. And governments have put a lot of effort last year, to their credit, of trying to ratchet those barriers down. A lot more to do, no question, but I'm hopeful and the momentum is there. Infrastructure in the center of this graph. This is clearly a federal priority, with the Major Projects Office trying to move the needle on the pace with which we can pursue major infrastructure projects or major resource projects. It's too soon to know whether that's successful or not, but at least the effort is pointed in the right direction. Productivity within the public service. It's a very large entity, of course, and so improvements there have outsized impact overall, and we are seeing efforts to make at least the federal government a little more efficient. We've seen a pretty material reduction in the size of the federal public service so far. not reversing things back to where they were before the sharp increase in recent years, but again, effort pointed in the direction of improving efficiency. Um, we haven't seen things though like tax and regulatory reform. Perhaps the lowest hanging fruit in terms of boosting investment incentives. The federal budget had a lot of tax policy changes that were of particular benefit to manufacturers. The marginal effective tax rate on investment falling from about 8% to nearly zero as a result of the budget. But those measures are targeted just to particular activities and temporary. So bigger, bolder tax reform over the long haul is something that we need to think a lot more about, to be frank. Now, my final point is that if we're to return to where we were prior to our productivity slowdown of the last decade, it may take a long time. How long is, contingent on how rapidly we can increase growth, how vigorously we pursue reform, how much more investment might rise as a result of policy changes, if at all. If we take the federal budget and the government's own optimistic goals as given, it suggests that what's possible under at least what the government has already done could boost growth by something the equivalent of 0.7% per year. Now, I don't flag that number to critique the government. That's a big change in annual growth. If we can achieve it, that would be great. It's the government's own kind of optimistic projection, so whether we achieve it or not is a separate conversation. But that's about the pace of growth that's roughly the average between the last two times post-World War II that Canada has converged to the United States. And so it's realistic. It's something we've seen in the past. It's the government's own number. So let's just take it as given. What would that mean for Canada's relative position over the coming years compared to the US? Well, it would mean it would take until 2050 until Canada's economy returns to where it was 10 years ago relative to the US. And so it's a multi-decade challenge ahead to boost growth, return living standards to the same relative position that they were at. And so it's not just one budget or two or 10. It is a generational challenge for governments at all levels to confront. And while there's a lot of momentum that built last year to try and improve investment and growth and productivity and so on, hopefully that momentum continues for many more years to come, even if the US returns to normal, let's say. So I'll end it here so that there's time for questions, but thank you very much. I look forward to the conversation.
There we go. Sorry, I had to click on my button there a few times. Thank you very much for that, Trevor. I'm going to turn to the audience for some questions, and there are a few questions from our audience today, and also some questions from folks on LinkedIn as well. So why don't we start off with Dennis's first question. Can you maybe just touch on the Alberta government's recent announcement, on budget announcement, and in what
Yeah.
areas are we spending higher than budgeted? And then the second question he asked was, what history says about long-term trade implications between important trade partners after a trade war. You did indicate that you feel that this was going to lag for a number of years, but maybe if you can reflect on that from a history perspective, that'll be great.
Yeah, two really good questions. And the first one is the easier one. What accounts for the increased spending that we are kind of currently observing federally? Sorry, yeah, in Alberta's budget, not federally. Well, the overall amount of spending that we see in Alberta this year, as planned, compared to what Premier Kenney's last fiscal plan would have led to, there's about $13 billion more. in spending. And that's with spending post-Kenny evolving with population plus inflation. So it is accounting for the pace of population growth in recent years being higher than normal. And that gap of 13 billion, what accounts for that? Well, health increases account for over half the increase. I reckon about 7 of the 13 and a half. Now, that shouldn't strike anyone as surprising. Health is the biggest area of every single provincial budget in the country. It is by far the driver of spending pressures here and elsewhere. Populations are aging as well. And so health is just going to account for a larger and larger share of the provincial budget, even for the same population. Because if the average age creeps up, a lot of our health spending is driven as we get to the final years of life. And so what matters is less the population and more the 65 plus population. And then you have education and um, post-secondary education. And if you look at education spending plus advanced education plus healthcare, then you get 90% of the excess spending in the past couple of budgets is accounted for by just those three areas. And so it is pretty concentrated in the core areas of public services provincially. And that I think opens an interesting debate in the province. The deficit and debt increases that we're seeing are without doubt driven by spending increases in excess of population plus inflation, despite what the government says. But it might be spent on things that have value. And so reasonable people will disagree over the merits of the spending choices, but there are certainly choices. It's really not about revenues dropping or some external factors. Of course, revenues have dropped with oil prices, at least until the last couple of days. And then the final point about what history tells us about the effect of trade wars, I think it is important to note the current situation is somewhat unique. And that makes history a poor guide for what might lie ahead. Some of the persistence that I illustrated in the Canada-US trade levels, that's quite interesting. I wouldn't have thought that the tariffed items would remain low even after the tariffs were lifted. And some of that might speak to some of the emotional reaction that Canadians have had. And I don't say that in a derogatory sense. I mean, the changing perception of the US as a partner, the desire of many to shift away from US products, that's unusual. And therefore, it's hard to predict how that evolves because it's then a question of psychology and things that go far beyond my expertise. Canadian history is also one where we don't really have a lot of examples where we've experienced this kind of shock before. The last time we've experienced big US trade policy change was under Nixon in the 1970s. And there, it wasn't really targeted at Canada in any particular way. It was a uniform tariff rate enacted then, I believe, of 10%. It could be 15, but something on that order. And it was everybody. And it wasn't targeted at anyone. And it was part of a coherent negotiation that was resolved around rejigging a lot of the fixed exchange rates tied to gold. And so then there was no real emotional reaction. Canada didn't retaliate. It was just a couple months. We figured things out, and then the tariffs were removed. Then you have to go back to the 1930s to find another time where we had a trade war with the US. And that's just not at all informative for today. So I guess to the second part of Dennis's question, I don't know, but it's going to be interesting to watch this unfold.
Maybe if you can just, as we talk about the US, reflect very briefly on what's happening with the economy in the US and has the impact of the trade war impacted US consumers? And do we sort of see a change in policy in the US?
Yeah, great question. Now, of course, we're seeing policy changes in the US all the time. And different things motivate that. And there is early research on the effect of tariffs on prices. In fact, maybe perhaps the best piece was put out by a team at the Federal Reserve Board of New York, which caused some political controversy, let's say, when that was made public. Now, not surprising, most of the tariffs have found their way into higher consumer prices, but in terms of the impact on inflation, keep in mind that the US tariff rate at the moment now on average on all goods is depending on the country, um, what did it average? 15% before the reduction that we've seen as a result of the Supreme Court case. And the overall level of imports in consumer spending is pretty low. And so we're talking about potential tenths of a point on inflation, which makes it hard to directly measure in real time. And so I can't give you an answer on how much of current inflation in the US is because of tariffs, but not nothing. Not enough to obviously see, but not nothing. And researchers will get more precise as more and more data comes out on that. In terms of the pace of US growth, uncertainty is a drag on growth there as much as it is here. Now we have I guess more sources of uncertainty, lots of policy changes as well that increases uncertainty. Much more of our economy is tied to trade than the US is. And so trade policy changes matter more for us as individuals and businesses than in the States. But the uncertainty has been seen as a drag on investment and growth in the US too, although I can't give you a specific number.
Mm. And maybe when we look at Canada's efforts to diversify our economy and recent efforts to build those relationships with Asia, China, and more recently India, can you give some of your thoughts on that?
Yeah, we shouldn't overstate the potential for diversification. I mentioned the 1930s. This was our main response at the time, following the Smoot-Hawley tariffs in the US. We retaliated a little bit, and then Bennett went and signed new free trade agreements with Australia and New Zealand and tried to get this big imperial trading thing off the ground. So trade diversification efforts in response to US trade policy changes, it was our strategy then, and it's our strategy now, but the scope for it is pretty limited for a couple of reasons. First, we have trade agreements with most of our major trading partners already. The Trans-Pacific Partnership, the trade agreement with the EU being particularly big ones. Also, several South American countries as well. So the EU signed an agreement with Mercosur, and we've already got all those members bilaterally, and for all but two of those countries. So a new deal with India, great, certainly welcome, especially long term, because India is going to be much larger relative to China in the decades to come. Great to see, but it really doesn't matter all that much quantitatively just because of how much of our economy is tied into trade with the United States. Distance and size are the biggest determinants of trade. And the US is big and close, and that's just the way it is. And the amount we trade with the US is already slightly lower than you'd guess based on their distance and size. So we've diversified in that sense already, through many years of effort on that front. But the scope for big changes because of a new arrangement with India is pretty small. Second point is the constraint on our ability to diversify trade is not really tariffs or regulations. It's the physical capacity to trade overseas. It's ports, it's rail. And that ties into infrastructure and investments there. And that's why expanding the Port of Montreal and expanding the Port of Vancouver and other initiatives to expand port capacity, that's much more important than trade agreements for, as the Prime Minister articulated, doubling the volume of non-US exports by 2035. That's going to come down to just our ability to do it physically.
Really good, strong points, and oh my goodness, so many other really great questions from the audience. But unfortunately, we are running out of time. Trevor, really appreciate your insights, data-driven overview of Canada's economic landscape. Really appreciated the conversation, your presentation on our trade uncertainty, inflation dynamics, labor markets, and this productivity challenge. Man, good Good conversations around that. I would love to sort of dive into that more in future sessions. For our members, again, understanding these macroeconomic forces is not academic. It informs sourcing decisions, investment planning, inventory strategies, workforce development, and ultimately affects our long-term competitiveness as well. So, as we heard today, uncertainty remains elevated, but informed leadership is our strongest advantage. And I encourage you to continue to come and join us in the future. As Supply Chain Canada, our purpose is clear. We exist to strengthen Canada's supply chain by strengthening the professionals who lead them. And we do this by convening experts like Trevor to here today, fostering informed dialogue, and providing professional development that equips you to respond to emerging risks and opportunity. So I encourage you to all stay engaged with our upcoming webinars. I think the next one is on Indigenous procurement. So I encourage you all to join us for that webinar and to join us for future professional development workshops again. Thank you again for joining us today, Trevor, and thank you all for joining us today and being a part of this conversation. We look forward to seeing you at future events. Have a great afternoon, everyone.